Thank you for that, Frank. This is Jake. You should be hearing me now. Thank you. So we are ready to begin. And as always, thanks for being here. Whatever day it is, whatever time it is, wherever in the world you are today, tonight, or tomorrow, thanks for being here. And today is going to be very different. The reason I say it's going to be very different is we're not going to be dealing with the standard type indicators or the standard type approach, or for that matter, my usual approach, although there will be some elements in today's presentation of things that we already know or should know. The bottom line is that we're going to talk about how to pinpoint market turns using small trader sentiment. I'm going to try and define for you as operationally as possible, as objectively as possible, what we do or what we try to do. People wonder, why is it that there's so many violent, volatile, excessive moves in prices these days? Small example just being what happened this week, just a couple of days ago, the European currency, which in a matter of minutes moved $2,000 to $3,000 down per contract, and then in a matter of the next several hours moved up around $5,000 from its low. And all of that happened not because of just a statement made by Mario Draghi in Europe at the European Central Bank, but also by an interpretation of a statement that he may have made, which is not exactly what he intended to say. Now, in the old days of trading, by which I mean 15, 20 years ago, things like that would not have been as extreme or may not have happened at all. So people ask, why is all of this happening? The usual answer would be, well, because there's better communication, there's more information than ever before, people are trading larger positions, everyone wants to get in at the same time, get out at the same time, computers are trading the systems, the markets, there's high-frequency trading, and all the usual answers. The answer is really this, in my view. Too many people are trying to do the same thing at the same time, and everyone wants to get the edge on everyone else if they're short-term or day traders. If too many people are trying to do the same thing at the same time, the moves are going to be violent. If too many machine trading programs are involved, and they're all trading basically the same algorithms or the same indicators or the same rules, then there's going to be violent price swings because there won't be too many people to take the other side of the trade. Remember that in the old days of trading, when we had the trading pit, the function of traders on the floor was to provide liquidity, to take positions when other people didn't want to take positions, and that's why the markets were more stable. Now, of course, it's just machine to machine, it's all electronic, person to person, peer to peer. And so there's really no one there to buffer the other side of the trade the way that floor traders did. But let's not be concerned about the reason why. Let's see what we can do to take advantage of this situation or to avoid getting involved in a situation in a bad way. If you are a student of my methods, you'll know that at least two of my methods pick that move very well in the European currency. But I'm not here to tell you about all of that. I'm here to tell you about something entirely different. So consider today to be more research-oriented, ideas that are still in development, even though the concept underlying what we do today started in 1987. So let me take you back in time. In 1987, excuse me, another trader came to me and said he had an idea. His idea was, why don't we find out what small traders are doing and then do the opposite? The reason, of course, was that the theory of contrary opinion, which we'll talk about more later on, was that the small trader is always wrong. Now, I take issue with that after having studied the small trader for many, many years. The small trader is not always wrong, because if they were always wrong, the indicator would be perfect, and small traders would never trade because they knew they were going to be wrong. The whole idea is that they have to be right sometimes. And of course, that's what makes the game worth playing. So when Mark came to me with the idea and said, let's develop this indicator and do the opposite, I said, well, who are we going to talk to? How are we going to find these people? I said, well, let's find people who are small traders, take a survey every day, put out a percentage of bullish response, and then see what happens. See if the theory is true. See if it's true that at major turning points to the downside, the majority of small traders are bullish, and at major turning points to the upside, the majority of traders are bearish. And so we began our survey, and it proved to be very correct and very accurate. So much so that when we began to publish our survey and make it available to the trading public, the vast majority of people who were interested in the survey results were not small traders. They were professional traders. And in a very short period of years, several years, some of the largest hedge funds, brokerage firms, and banks began to get our data at the end of each day because they used it not as a trading system, but as an input into their process of decision making. Why were they so interested in it? They were so interested in it because it was different. It was different than what 90% of everybody out there was doing. It was an index not based on moving averages, not based on prices, not based on traditional indicators, stochastic, or any of that stuff that are all related to price and all derived directly from price, but rather derived from the perception of price. In other words, how do traders perceive or see a particular market or result or price or trend? And in so doing, one moment please, ladies and gentlemen. So you're saying you can't hear me, Sharma, Shams? Can everybody else hear me okay? Because I have my volume turned up all the way, I can try it. I can try turning up a little bit higher, but then we might get distortion. You hear me twice? Well, I'll tell you what, I won't charge you double. You're getting an echo. Is everybody else getting an echo? No. Okay, well, we're just going to continue and see what happens. So as I was saying, the whole idea behind what we're going to do today is an indicator of market behavior, not based directly on price, not based on, very funny, Steve, but based on the perception of price. And think about this. People perceive things differently. 10 people can look at the same situation and see it in completely different ways because it goes through the filter of their brain and their mind and their thinking. And so therefore, if you have a report that's supposedly bullish, some people see it as bullish, some people see it as bearish, some people see it as neutral, some people won't even pay attention. But what I'm interested in is when most people see things the same way. Because when something is viewed by many people and it's extreme, they tend to have an extreme reaction to it. And we know that in the markets, having an extremely emotional reaction as a trader is usually wrong. So I'm not here to tell you that the small trader's sentiment, which we're going to look at today, is always going to be right, by which I mean that the small trader as a group is always going to be wrong. But I'm going to show you some numbers that are compelling. I'm also going to tell you this. The area of research to make this sentiment indicator work even better is wide open, by which I mean I make the data, historical database available to anyone who wants it. Massage it, do research with it any way you want. Clients to the data pay a lot of money, but they get the up-to-date data. And I have some insight as to how some of the big hedge funds use this information, which I'll share with you today. So what we're going to do today, very simple, very straightforward. I'm going to show you some ideas, and then we're going to deal with the ideas in an objective way. So Bertrand Russell said that the dread of disaster makes everybody act in the very way that increases the disaster. So think about that. You're thinking about something that's making you nervous, then it happens or doesn't happen, and you're just thinking about it, and you get very tense about it, and that's what happens to markets. So when a report is supposed to come out and it's supposed to be a negative report, many times people will overreact to that negative report, even though it's only slightly negative. Then 15 minutes later, they'll come to their senses and say, well, wait a minute, I think I overreacted. So the whole idea behind this is that the market sentiment index is based on how small traders view price behavior. When the small traders are neutral, it doesn't tell us any information. I'm only interested in extremes because by being interested in extremes, that's when I learn a lot about markets. So we're going to go forward and take a look. And by the way, the slides are located for download in the documents area at the lower right-hand side. So let's take a look at this chart. We're going to come back to this chart a little bit later on, and I'll tell you exactly what it is. But bear in mind that what I have here is a daily chart of S&P futures. And at the bottom of the chart, I have an index derived from market sentiment. So I've got a green line and I've got a red line. And if you take a look at the chart and just do a little bit of very quick analysis of the chart, buying when the green line crosses the red line over here, getting out when they cross and reversing over here and here, over here, and again. And if you take a look at these trades, and you take a look at the trades and use these trades or these crossing points as triggers, and you have a profit target and a follow-through, you will find that the vast majority of the signals, like buy over here, sell over here, buy over here, sell over here, buy over here, sell over here, and so forth. And then the most recent one, which is still long, buy over here, excuse me, buy over here is still along this market. That the vast majority of these signals turned out to be profitable trades. Not seeing my pointer. Okay, hold on one second, please. Let me rejigger that. Okay, hold on one second. We'll go through it again. One moment, please. Okay, no worries. I'm getting it back. Just have to find what they did with it because they've changed things around. How about... hold on a second. How about... moment, please. How about now? Success? Okay, so let me go back to this one. The green line crossing above the red line is a buy. The green line crossing below the red line is a sell. A buy and a sell. Stay short. Buy over here. Sell over here, and so forth. And the most recent one, buying over here, and still long even after today's 30-plus point rally in the S&P. Now remember, these are raw signals. These are not signals containing a follow-through. It's simply reversing system. We know that in my work, I don't do that. Every trade has a target and a follow-through and a profit maximizing strategy. So that once a trade goes profitable, as it did over here, we're not going to let it get back to over here where it turns into a loss. But I'm not presenting you with a trading system today. I'm presenting you with a concept. I'm presenting you with some things that you can do on your own. If you have the interest in doing some research, you can make this much better than I have it here. So let's come back to this later on. let's talk about a couple of things. Today, we're going to talk about market sentiment and how to use it. I'm going to talk about the theory of contrary opinion and the daily sentiment index. I'm going to talk about different ways to manipulate the daily sentiment. And let me say, before we go on then, and say this. If you knew, like I do, who's using the daily sentiment index, you would not believe it. In the past, I've revealed the names of some of the firms that are using my index. You won't believe it. You won't believe it because you're going to say, why are all of these top hedge funds and banks and brokerage firms using the service? The reason is real simple. It's working for them. And I will share with you some number of other very important things. We publish the sentiment index no later than 2 o'clock California time. Sometimes if we're late, the phones here ring off the hook. And who is it that's calling? It's all the big hedge fund clients. Where's the daily sentiment? Why is it late? How can we get it? We need it soon. How fast are we going to get it? Because it's an integral part of their decision-making process. Now, I'm not saying that they use it as a trading system. But when you see how the correlation goes between extremes in trader sentiment and price highs and lows, you'll understand why it's so valuable to them. And I'm not trying to get you to buy it. It doesn't matter to me. I do the research. I provide the data. We've got plenty of people who get this. What I'm saying to you is, if you have an orientation to do some research, this thing is wide open. By which I mean, there are so many more things you can do with this than I have. So I'm going to show you different ways to use the daily sentiment index and how we add timing to it. I'm going to show you some of the history of daily sentiment in a number of markets. I'm going to show you 5 different ways to implement it to improve the trading. In other words, how to use it as a tool with some of my other work so that you can say, okay, it appears that there is a momentum divergence trigger to buy crude oil. What does the sentiment say? Is the sentiment extremely low? Is the small trader very negative on crude oil? Well, that's interesting. We've had a divergence set up and trigger. The small trader is very negative. Beautiful combination. Is there a timing indicator that we can develop out of the sentiment indicator to confirm the indicator that we're using in our work regularly, such as divergence, 8 open close, and so forth? And the answer is yes. I want to show you how this all works together. For one purpose, of course, to improve your timing. For the one purpose, of course, to make more money or to lose less money, or to manage your trades more effectively, or to make fewer trades with better results. We're going to look at some daily and weekly data for the daily sentiment and some monthly data. We'll look at short-term and intermediate-term trading. We're going to talk about the behavioral characteristics of market sentiment. It's very important to understand when to use a sentiment and when not to use a sentiment. And we're going to talk about why the small trader is not always wrong. And we're going to see some very clear evidence which makes you very suspicious about being too negative about the market, too positive about the market just because the small trader is negative. In other words, I'm saying don't, excuse me, don't always find yourself wanting to do the opposite of what the small trader is doing, because there are many times when the small trader is right. So don't buck that trend. Use it as part of a process. So again, I'm going to stress what I always do. It's a process. Use the process. As I said, I will provide you with all of the sentiment history. Do what you want with it. Chris Moody is here, and he's developing I believe he's already developed the ability to look at the daily sentiment index on the TradeStation software. It's already available as an add-on to the Genesis software, so you can see how I use it. Okay, so look, 56 of the top hedge funds in the world use the daily sentiment in their work. 6 major brokerage houses, at least 3 of the biggest advisory services in the world, including Elliott Wave, many banks, and a lot of big data analytic firms. Why? Because the daily sentiment gives them another way of looking at markets that's not related to what they're already doing. If you go to a trading software program like Genesis and you bring up the indicators, you're going to see there's probably about 100 indicators there. As I said before, Practically every one of them is derived from price. They look at price as a moving average, as an oscillator, as a divergence, as an MACD, as an ADX, and so forth. Because most indicators are related directly to price, they will look the same, other than if you use different periods. So 14-period moving average is going to look a little bit different than a 7-period moving average, but it's still going to be related to price. The sentiment is not related to price, and I said before, I'm going to say it again, it's related to the perception of price, and that is extremely important. So let's take a look at a couple of things. 90% of all indicators are based on price. Most of them do the same thing most of the time. Let's talk about contrary opinion. Contrary opinion is a theory that in order to make money in the market or to be right on the market, you have to do the opposite of what most people are doing. That theory has been around for a long time. There's books about it. But here's the bad news and the problem. The problem is that contrary opinion, which is based on emotion, is difficult to quantify. How do you put it into numbers? That's what we try to do when we do the daily sentiment. That's what they try to do when they do the put-call ratio or the odd-lot short sales. So they use that as an index determining what the small trader is doing so that we can do the opposite. But listen to me, this is really important. As I said before, we don't want to do what the opposite of what the small trader does just because the small trader is in the majority. It's a leading indicator. It's a setup. We need a trigger. So let's go back to all the work that I've been preaching for such a long time. Setup, trigger, follow through. I'm going to show you the setup. I'm going to show you a couple of different ways to use the trigger. Then the follow through I will not be showing you because I haven't worked that out yet completely, but I'll give you some ideas about it. So the rules for using contrary opinion in trading are very different than the rules for most indicators, but there are some similarities. We're going to look at those. So why bother using, it should say, emotion as an indicator? It's because emotions reign at market turns. So when we have major market turns, as you will see on the charts that I'm going to show you, it's undeniable in almost every major turn that emotion has been very strong. Sentiment has been very strong. Opinions have been very strong. And so, for example, if you take the current presidential election in the United States, or the campaigning, sentiments run very strong about certain candidates. Oh, this one is really no good, everyone hates him, everybody loves him. We find that when the majority is in very strong agreement, there's a problem, and that problem is that usually the opposite happens. So for example, volatility. Volatility is very simple. It's very emotional. Traders are very emotional these days. As I said before, when you have moves like this, which happened on Thursday, I'll show you if you haven't already seen it. In a matter of minutes, Mario Draghi makes a speech. European currency futures drop $1,800 in just a matter of 15, 20 minutes, maybe half an hour, and then proceed to rally $5,000 or more through the rest of the day. It's a huge move. It's one of the biggest moves I've seen in a long time. Why does it happen? It happens because traders are trying to do the same thing at the same time, or they've got their orders in the same place at the same time, or they're trying to use the same trading strategies, or computers are getting in and out at the same time, and that's the problem. So what we want to do is we want to take advantage of that situation if there's a way to do it. Now let me stress, market sentiment, as I use it, is not an intraday indicator. It's not a day trading indicator. It's designed to do one thing and one thing alone. Actually, two things. Number one, to let you know that something is about to change. Number two, to let you know when it has changed. Those are the two major things that it wants to do. But it doesn't focus on small moves. So we're going to deal with the issue of reliable anti-authority, which comes from the philosophy of logic. A reliable anti-authority is an individual who is almost always wrong about a particular subject. Let me share something with you. In the years that we've been doing the daily sentiment, we've had some individuals in the survey many years ago who were wrong about everything. When we did the survey, we asked, are you bullish or bearish? And we give them the name of the market. They'd give us a yes or a no, or they'd send in a fax or an email. We found that some individuals were never right. Now, that's very unusual. Most of the time that doesn't happen. So we're trying to find reliable anti-authorities. And even though it may sound a little bit irreverent to you, what kind of individual are we looking for to be in our survey? We're looking for a particular individual. Am I interested in getting the opinions of professional traders? In other words, if I were to make a phone call to 100 professional traders all over the world and say, what's your opinion today? And read a list of markets and have them say bearish or bullish. Would that be a realistic way to do my survey? Well, the answer is no. Thank you, Frank. Why no? First of all, professional traders won't give you the time of day. They're not interested in sharing anything with you. It's cutthroat. So you won't be able to reach them. I could make the calls and I could reach most of them. They'd probably talk to me. But number two, they'd probably lie to me. Why? Because it's a very competitive business. So they're not going to tell me the truth anyway. So forget about that. I'm not interested in what the professional trader is doing. I'm interested in the opposite side of the equation. I'm interested in what the less educated, less experienced trader is doing, because that is the trader is most apt to be wrong most of the time. Now, I didn't create that situation. That situation would exist with or without me. I'm not perpetuating the situation of ignorance. In fact, I'm doing my opposite to change that by educating people. But the fact of the matter is that there's so many people coming into the markets every day who are absolutely ignorant, who are grist for the mill, who will lose their money, and they will lose their money faster than ever. I want to assess the opinions of those people, not because I'm a bad person, not because they're a bad person, not because they're a loser in life. They may be, but the fact is that their opinion is very important to me. And it's not the opinion of any one individual. It's the opinion of a group of individuals. So if I say to 10 people, are you bullish or bearish? And I get 5 bullish and 5 bearish, it gives me no information. If I say to a group of 10 people, are you bullish or bearish? And 9 of them say they're bearish, that means something to me. Now, obviously, the more people I can talk to, the better off I am. Determining how to get this, in other words, getting this information, is proprietary. Suffice it to say that I have my way of getting the information, and that's the most important thing. The most important thing secondarily is, does the information hold true to the trends of the market? Does it have predictive value? We're going to take a look at some of that today and determine whether this has potential for you. Let me say also this. These numbers, the Daily Sentiment Index numbers, are available for every active U.S. futures market and a number of the European index and interest rate futures markets, equity index and interest rate futures markets. Every single trading day is in our historical database back to 1987. That's a ton of data. And so a lot of the hedge funds who buy this data from me, who get the service from me, will get the data, they'll do the research, and within a matter of days they'll come back and they'll say, we want to get a subscription because it's working for us. So let's talk a little bit about this. Let's talk about machines and emotions. You may say, well, sentiment's not going to work anymore as we go into the future, because in the future, and even now, a lot of trading is going to be done by machines. Machines are unemotional. They can't feel anything. So can a machine trade on emotions? Before you say no, think about it. No matter how good a machine is, that machine's going to be affected by the emotions of other traders. And so if other traders en masse begin to sell, no matter how good a machine is, it's going to be affected. The whole idea is to make the machine able to take advantage of that emotion and use it. And that is also true. Programmers of machines are coding emotionally. They may very well be. So the bottom line is, I don't care about computerized trading systems making this not work. All I care about is, will there continue to be emotional reactions in the markets? As long as there are people who have money, as long as there are central banks who have money, as long as there are people who spend money, who earn money, who need money, as long as there are capitalist economies, as long as there are economies that claim to be communist but are really capitalist, there's going to be reactions. These reactions are going to have an emotional impact because nobody wants to lose their butt. Now, let me stop and say one more thing. Why would it be, therefore, that if this data is available to small traders who are part of the survey or to big traders, why wouldn't everybody be using this information? That's a perennial question. Why don't more traders use seasonal trading information, which has been shown to be up to 90% accurate? The answer is real simple. Everyone's got their own agenda. Everyone has their own style of trading. Everyone has a different goal in the marketplace. Some people want to trade in the 5-minute time frame. And there's another way of saying this. I'm going to try and say this in the most polite way. No monkey likes to look at his own rear end. By which I mean, nobody wants to look at the data and say, yep, I'm one of these small traders, and our data is very negative, and I'm one of those people that's really bearish on the market, and I know that the market's bottoming, but I don't want to admit that the market's bottoming because I am very bearish and I feel it in my gut, and I can't get away from this feeling, and I have to trade on the basis of my feelings, and that's all there is to it, and leave me alone. So there's a lot of denial. So let's take a look at a couple of things, look at some charts, and then we're going to get into some detail. Remember that what I'm telling you is not a trading system. I believe in my heart of hearts that you can make it into a trading system. I'm going to be giving you a couple of elements to that system today, to that process today. But in addition to that, remember this, there are many top-notch traders in the markets today using this data as part of their trading strategy. Okay, so why does contrary opinion and sentiment work? It works because when traders are very negative, most of them have done all the selling that can possibly be done, and therefore there's no place for the market to go but up. Or when traders are very bullish, most of the buying's already been done, and there's no one left, or very few people left to buy the additional contracts or shares from those people. So we want to answer some questions. When is oversold valid? In other words, when does the market go too low? How do we know it's gone too low? How do we know it's gone too high or overbought? How do we measure contrary opinion? We're going to look at all of these issues right now and talk about them. Let's do it. The best way to do it is with a chart. Let me get a chart for you. Here's a chart. Let's take a look at it in detail. This is a long-term quarterly chart of Treasury bond futures on the top, and on the bottom is the daily sentiment indicator from my research, which we gather every day. The daily sentiment index varies from 0 to 100. At 0, no traders in the survey are bullish. They're all bearish. At 100, they're all bullish. In actuality, we don't ever get to a 0 or 100 because there's always somebody who's a little bit different. There's always someone who's going to be negative or positive when everyone else is positive or negative. Let's look at some correlations. So all I'm looking at here is this. I've got a bottom line, which is 25% bullish or 75% bearish. I've got the top line, which is about 75% bullish. And we're looking at some extremes. Right now, I'm just going to look at lows. Let's only look at lows. So over here, back in 1995 or whatever it was, market sentiment on a quarterly basis, in other words, looking over the course of 3 months, dropped almost to 0. And that was a leading indicator, and it led a significant low in the market by 2 quarters. Then, a couple of years later, we dropped below 25, and that correlated closely with the start of another big move up. This one This bottom here, it entirely missed. Not perfect. Over here, again, a very low sentiment reading. Most people were negative, and that was the beginning of a move up. And then again, not too long ago, another extreme move to the downside preceded the big bull market that we've been in since then. And these are no small moves. This is a move from 130 to about 155, which is a huge move dollar-wise. So looking at this chart, without manipulating the data in any way whatsoever, excuse me, you see a near perfect correlation between lows and sentiment and up moves in the markets. Remember this, the sentiment is a leading indicator. Sometimes it correlates exactly to the same time as the start of a move, but most of the time it leads, and that's why it's so valuable, because it tells us ahead of time something's going to happen. So before I leave this chart, remember, I'm not showing you a trading system, I'm just showing you a correlation. Are there any questions about this chart and what it says? Okay, let's go on. Next chart. Now let's look at the tops. Same chart, Treasury bond futures, tops. Here, 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 and recently. So what's the correlation? Again, the correlation is not perfect, but it's a leading indicator. And remember, we want to take this work and combine it with something else that's going to give us timing, that's going to give us a trigger. I want you to remember something very important. The small trader index, daily sentiment index, can be right for a long time. I'm going to show you a couple of particular situations, and then what we need to do is to be able to deal with them. The difference in significance of daily sentiment and quarterly. The difference is, are you a short-term trader or are you a long-term trader? Are you a short-term trader or are you an investor? If you're an investor, using the monthly data or the quarterly data or even the weekly data. If you're a short-term trader, using the daily data. Do you find divergences at both extremes in the indicator to be tradable historically? Yes. But I found something much better, which I'm going to share with you today. Remember this. The sentiment has an upper limit and a lower limit. Any indicator that has an upper and a lower limit is problematic, because if it goes to 90 and you say the market is overbought, then the market keeps going higher and the indicator goes to 95. Do you say the market is more overbought? Then the indicator goes to 99 and the market keeps going up. Are you saying, then what do you say? Is it overboughter or is it overboughtest? So the problem is, the concept of overbought and oversold is very difficult to deal with when it comes to indicators that go from 0 to 100, such as sentiment and stochastic. So we have to find a different way. And what we want to do is we want to combine divergence indicators at both extremes with sentiment. And I'm going to show you later on how to do that. And again, I'm giving you a bunch of ideas that you can develop on your own, or you can correlate in the way that I've done it and see how it helps your trading. It has helped me tremendously, absolutely tremendously, as well as those individuals who've been coming back for years and years. We've got people who started with the daily sentiment index on day number 1 and are still with us because they keep finding the method, the data to be very useful in their own methodologies. Let's look at another one. Crude oil. Again, in this case, it's a weekly chart, and we're looking at the extremes. So let's look at the extremes. There's a high in sentiment, a high in price. There's a high in sentiment, a high in price. There's a high in sentiment, which leads or precedes a high in price by about a month or two. And then, since the bear market has started, there haven't been any extremes to the upside. There have been extremes to the downside. Let's take a look at the downside. The bottoms. Extreme low correlates with a low in price. Extreme low in sentiment correlates with the low in price. Extreme low in sentiment correlates with the low in price. A very strong low in sentiment correlates with the low in price. And remember, these are not small rallies. This is a rally from about $45 to $62. This is about a, what, $12,000 rally we're looking at here. This one over here, and here's where we were just recently. So not too long ago, at the beginning of this year, sentiment dropped to another very low level. And so what would you do with this in terms of making the sentiment indicator valuable to you? What does it say to you? Here's what it says to me. It says the market is extremely low. Sentiment is very negative. The small trader is throwing in the towel. The small trader will probably be wrong. So what's my next step? My next step is let's go to a timing trigger and get long this market with another indicator that will give us timing. If you assumed that this was low and you used the timing trigger to get into this move, remember, looking at this chart, this is a $10,000 move over here. So is it a potential moneymaker? Yes, it is. But remember, we need that last element, which is timing. I'm going to show you a few ideas about that. Or if you're familiar with my timing triggers, you already know how to put timing with this, but I'm going to show you in very unique ways. All right. Now, let me show you something else about sentiment. Here's the thing that's so amazing to me. Over here, traders say, yes, the market's going higher. We think it's going higher. They think it's going to go higher. Then it starts to go down. All the way down through this big collapse in prices over here. The small trader sentiment is, it's okay. We're negative. We're not that negative. We're only 50% negative over here. And over here they say, oh yes, it's definitely going lower. So what I'm saying is it's sort of like, wake me up. When do they wake up? Usually the small trader as a group, now remember this is as a group, is not negative individually that we're looking for. We're looking for collective negativity. We're looking for situations where the small trader is, as a group, 75% of them negative or 75% of them positive. And the more extreme the number is, the longer they stay in that direction, that particular orientation, the more significant is going to be the move thereafter. Let's take a look at another one. And if you have questions on any of these charts, let me know. Let's go to the next slide. So this is the chart. I'm going to go back. This guy right over here is this right over here. So we took this chart and we zeroed in on it right over here. Okay, so this is what it looked like on a weekly basis, close up. So during this period of time, remember what I said. Over here, the small trader went very negative. And they were right to be negative. I'm not saying that just because the small trader is negative that you want to be a buyer. What you want to do is find a timing indicator to get you into this move. Another characteristic of the sentiment is this. It'll be very negative, then it will pop right back up over 25%, then get negative again, and on this second pop back up is when a lot of the big hedge funds are buyers. But I'm going to show you some more specific information because this is not specific enough for me. As you know, if you're familiar with my work, you want to see more specifics. Let's take a look at another one. In other words, we want to see details. Okay, just one moment, please. Let's go to the next one. Let's take a look at the S&P. And again, let's do some correlations here. And I'm sorry this chart is a little bit blurry. A high in sentiment, a high in price. A low in price, a low in sentiment. A series of highs and lows. And if you take a look at them closely, you'll notice the correlation. So subsequent to each one of these highs in sentiment, we had a reaction down. And remember, this is a big chart. These are fairly large moves. Let's go to the bottoms. Here's another top right over here. And this is a significant top right over here that preceded a correction down. This is a top right over here that preceded a correction down. This one is a low right over here that preceded this big rally. Another low over here. And this is where we were just recently. Now, this goes back to January of this year. Let's take a look at what happened on a close-up. Hold on a moment, please. That's what it looked like back then. Let's zoom in on that and take a close look. And that's where we were. So remember what I said, very important. When the small trader goes negative, below 25% sentiment, don't jump in and buy. Start to look for timing triggers. This is not a timing trigger. This is not a timing trigger. But what happens is, if we take a timing trigger, and if you're familiar with my work, you've got at least 5 or 6 timing triggers, all of them should be looked at, and they should be looked at closely when they correlate with low sentiment. So if you did momentum divergence, for example, and started looking at a potential buy trigger over here, you would not have gotten one until quite a bit later on when the sentiment was bottoming, when the sentiment went back down again and you actually did get buy trigger. So the correlation between sentiment and buy trigger was very high. Let's take a look at some others. Just bear with me for a minute. Next slide, please. How about the recent rally in gold, which has been a $20,000 rally? What's the correlation? Sentiment dropped to as close to zero as I've seen it in a long time. And we had again that pattern that you're going to see over again, that double negativity in sentiment. So it starts to come down, it stays down for a while, and then it turns around and goes up. And this is a weekly chart. On a daily, of course, sentiment remained very low for a long time, which is why it's important not to jump in just because sentiment is low. And I will say that over and over again. You're going to get tired of hearing about it. Use timing triggers to get into the trade. And by the way, if you've got a timing trigger, not necessarily my own work, but your own work, and you like it, you will find that it works better when you put it together with sentiment. Let's take a look at another chart. Now take a look at this. What is your favorite timing trigger? For the short term, I like 8 open close. For an immediate term, I like momentum divergence or MACD divergence or oscillator divergence. For investment type trades or swing trades, I like the moving average channel. But for use with the sentiment, 8 open close and divergence have been miraculous combination. Okay, now I want you to take a look at this. Here's a chart of sugar. There are 2 extremes on this chart. This one here and this one here. This one here is the most recent one. And you'll notice what happened to sentiment. It dropped well below 25. We've been in the midst of this huge rally which accelerated even more today. And over here, the correlation to the very day with price of the highest sentiment is uncanny. And you will see this time and time again. The real question is, how do we use this? Obviously, if I said, it's too high now, 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 I need something that's consistent, and I need something that's more objective, and we're going to try and find that, and that will be not only my job, but your job as well, because I believe sincerely, if the hedge funds could do it, and they've got some brilliant people working for them, we can do it too, and in fact, I have done it. I'm going to share some of that with you today. Let's go on to the next chart. Let's take another situation. If it goes above the line, do we tighten up stops if we are long SGG? Remember, Joel, I haven't presented you with a trading system here. If you're long SGG, the sugar ETF, what you will do with the sugar ETF as a follow-through will depend on the method that got you in. Remember what I've been telling you for a few years now, right? The method that gets you in is the method that gets you out. If you didn't get into the sugar with sentiment, if you got into the sugar with a divergence trade or a moving average channel, then you have to follow through with the moving average channel rules. Is that clear? Okay. Let me show you another one. Let's take a look at lumber. This chart is a little bit different. The red line on the bottom shows the raw sentiment. In other words, you can see that this red line is kind of jaggedy and it goes back and forth a whole bunch. And that is because trader emotions vary significantly from day to day. It's not unusual to see small trader be 15% bullish today and then 25% bullish or 28% bullish tomorrow. So in order to slow down the extremes of sentiment, the extremes of emotion, we take the red line and we run a moving average of the red line, which gives us the blue line. The blue line is a little bit slower. It doesn't move back and forth as much, which is what we want. We want to slow down the sentiment so that it's more useful to us, but we don't want to slow it down too much. Remember, every time you run a moving average of a number, you decrease the sensitivity of that number. So everything gets shifted forward. So for example, this low over here is the raw data. This is the low in the moving average. This is the raw data. This is the moving average. So you want to slow it down, but remember, you want to be as close to the bottom and the tops as you possibly can. So finding the right balance is very important, and we're going to do that. Let me show you something else. Now let's take that red line, which is the jaggedy line, which is the raw sentiment, and remove it, and only show you the moving average. Now it's more human. We can use it better. And again, I want to show you the correlation. Highest price on the chart, at that time the highest sentiment on the chart. Low, here's that double low that I was talking about that happens very frequently, correlates with the low in price. Another one over here and right over here. So let's talk about lumber, which was, if I'm not mistaken, limit up again today. Remember, I'm not talking about lumber as an investment here. If you're familiar with my work, you know that I predicted this lumber move a long time ago. You know that it portends real estate values moving up. It portends profits for home builders and home ETFs and XHB and all the rest of that stuff. I'm looking at this right now on a weekly basis. So if you're clear on what I've been telling you up until now, what can we determine about the lumber market right now? Would anyone hazard a guess? And I want to do this before it happens so that you can think about this and come back to it 3 or 4 weeks later, later than now, maybe 2 months later, and say, that was interesting. We came to some conclusions and they were right. Does anyone want to hazard a guess? Okay, there's nobody. Okay. Overbought, that's one way of saying it, yes. Let's put it in operational terms. The small trader is mostly bullish. That's the exact way I would say it. Overbought would be another way of saying it. Right. So look, I am not going to stand in front of this train. Remember what I said. The small trader can be right, and they will be right, sometimes for extended periods of time. I don't care about being right as much as I care about making money. I don't care about making money as much as I care about not losing money. I don't want to stand in front of this train. But what I do want to do now is I want to go to my indicators. My indicators will work best when sentiment is at its extreme. So just as I went to my indicators down here and said, let's look for a buy trigger, I'm now going to my indicators and say, let's look for a sell trigger. This is a weekly chart. That sell trigger could be a weekly divergence, bearish sell signal. It could be a weekly 8 open close trigger. I'll show you some of those momentarily. So the bottom line is, lumber is doing exactly what it's supposed to do. We are at 82% bullish sentiment. It's a very high number. It's the highest we've been in a long time. It's the highest we've been since here. My orientation here. Be careful. If you've got some new money to invest, don't put it into this market right now. The time to have done that was back here in September of last year. Okay? All right, let's go forward. Here's the problem. This is a chart of the Euro Bund, the bond traded in Germany, the Eurex. Very similar to our long bond over here. Let's take a look at trader sentiment. Exactly the way we did before. Now this is sentiment slowed down with the 3 moving average in order to make it more human, more usable. Let's look at the lows for a minute. There's a low in price, low in sentiment. It's a beautiful thing. Low in price, low in sentiment. It's a beautiful thing. There's our double bottom, beautiful thing, everything's wonderful. But here's the problem right over here. The problem is it goes above 75% and stays there for days and days and days, weeks on end. And during this whole period of time, if you're saying, it's time to sell, it's time to sell, it's time to sell, you're wrong and you're losing money. So remember what I said, I'm going to say it many times and you're going to see it many times. Sentiment going above 75, just like we just did in the lumber, which is above 80, 82%, is not a call to action. It's a call to the chart. It's a call to the indicators. It's a call to you saying, be careful, look for sell signals, and if you get sell signals, take them. But the probability is you won't get any as long as the market remains in this strong uptrend, in spite of the fact that sentiment goes to its highest levels it's been in a long time. And even if we take this number right over here, the highest one we've had, which correlates all the way over here, it was still a leading indicator by several months of this big decline in price. But remember, these are not calls to action, these are calls to observe and watch for triggers. Let me show you something else. Let's take a look at the Nikkei. And again, I want to look at it with the same perspective that we looked at the sugar. There are two extremes in price on this chart. The highest high, right over here, and the lowest low right over here. It's not surprising to me, although it is uncanny, that the highest high on the chart, in terms of the sentiment, correlates almost, if not exactly to the day, almost to the day of the high in price, and to within 1 day of the low in price. So these are things to be observant of. Another one right over here, another one right over here. And this is that double bottom behavior that I talked to you about before. What I want to do is quantify this. I'm not satisfied just to look at the chart and say, oh, this is a great thing, this is a thing of great beauty, it's got beautiful sex appeal, can we use it, can we put it in a book, can we talk about it? Because if I take this chart and I give it to 10 different traders, I'm going to get probably 9 different answers. Sell it right now, you should have sold it before, why didn't you sell it before? Do it now, and all these answers will be different. I don't want that. I want us to all agree on something and see it objectively. So what can I do with this? I'm going to show you momentarily. Let's go forward for just a second here. I'm going to add a trigger. I'm taking the same chart. This is the blue line we looked at before, and I added a green line to it. Does that green line do anything for me? What is that green line? So what I've done is I've taken the blue line, and I've taken the moving average of the blue line, and that is the green line. Let's not talk about what the moving averages are right now. I'm going to cover all that with you. Let's talk about it a little bit differently and ask another question. By adding a moving average of the moving average, so let me back up and tell you what I mean. This blue line is not the raw sentiment. This blue line is a 3-period moving average of the sentiment. But in and of itself, this blue line is still too jaggedy. I want something that's smooth. So I take that blue line and I take a moving average of the blue line. Don't worry right now what that moving average is. I'm going to cover that for you shortly. But let's talk about the process. When the blue line goes above the green line, would that work as a buy trigger? When the blue line goes below the green line, would that work as a sell trigger? So if I turn these into buy and sell points and made these into a trading strategy, would that have potential? Would it be long from all the way over here so far? The answer would be yes. So this is the beginning of something in the way of a process of research. Let's go forward and look at something else. And by the way, I'm going to skip this for just a moment. I'm going to skip this for a moment. I'm going to skip this for a moment and come back to it. So just bear with me. We're going to go to odd lot short sales for a minute. So the bottom line is this. Hold on one moment. The bottom line is this. I want to take these extremes and turn them into a trading system. Even if you don't turn them into a trading system and you use them as a filter for what you want to do, the approach will be very valuable to you. You will make fewer trades, and the trades you make will be better because the moves will be bigger. So let's talk about this. In fact, let's go to this slide right over here. Most traders will be wrong at important turning points. That's what we learn. The largest bullish sentiment will occur at or near tops. We know that for a fact. The most bearish sentiment will occur at or near bottoms. That's for a fact. And it's really not that simple because we have to take it and turn it into some sort of a quantifiable process. I'm going to skip a few slides and show you what I mean because I can cover them better another way. But before we do that, let's talk about something else. Many traders are not familiar with the odd lot short sales theory. I want to cover that with you because odd lot short sales is a powerful indicator and most people never even heard of it. Odd lot short sales, very simple. A round lot in stocks is 100 shares. So if I buy 100 shares of a stock, I'm buying a round lot. 200 shares is a round lot. 300 shares is a round lot. Anything less than 100 shares is an odd lot. 97 shares, 3 shares for my son's graduation or something like that. The theory is, and has been for many years, that odd lots are not traded by large traders. Odd lots are traded by small traders. Somebody might wake up and say, you know, I think Amazon is going to go higher. I'm going to buy 2 shares because I can't afford 100 shares. So the person who can't afford 100 shares they're still interested in Amazon. Maybe they'll buy 3 or 4, or they'll buy 77 or whatever. Traders are especially interested in what the odd lot numbers are because they know that that odd lot buying is being done by someone who's not a professional. And therefore, if they're not a professional, they're likely to be wrong. So for many years, traders would look at the odd lot data, which comes out, is published every week. How many odd lots of stock were bought this week? They would take that number, the odd lot long positions, and graph it against price. And supposedly they would notice that when odd lot buying was very high, in other words, there's a lot of small people buying odd lots of stock, that correlated with highs in the market. And that was a pretty good indicator, very similar in response to the daily sentiment index. But what they found out was even more impressive. Odd lot short sales. What's that mean? Very simple. The small trader, the inexperienced trader, does not know very much about selling short. Most of them don't even know what selling short is. So somebody says, we think the market's going to go down. What can we do about that? Is there a way for us, the small trader, to make money in a down market? Somebody says, oh yeah, all you got to do is sell short. Selling short, I don't even understand how to buy. What do you mean you want me to sell short? Oh, it's very simple. Sell something that doesn't belong to you and buy it back later and you make money at a lower price. Oh, that sounds interesting. I don't know how it works. Let's do that. I want to sell short Amazon because I think it's going down. They've had a very bad Christmas season. I want to sell it short. Okay, how many shares do you want to sell short? 6. You want to sell short 6 shares of Amazon at $600 a share. So if it goes down $100 a share, you make $100, and 6 shares, you make $600. Is that what you really want to do? Well, that's all I can afford to do. Well, if that's all you can afford to do as a small trader, don't do it because you don't understand the process. So traders became very interested in odd lot short sales, much more so than odd lot long positions. They would say, we want to find out what the odd lot short sales are this week because chances are if the small trader who doesn't really understand the market is selling short, which is mostly what a professional will do, and on top of that they're selling short small amounts of stock, then the market is going to be bottoming because this spike in odd lot short sales only happens at bottoms, and that's what we want to look at. Now, if you want to study odd lot short sales, okay. It's all over the internet. I believe it comes out of the government, either out of the Securities and Exchange Commission or the exchanges themselves. But if you take a look, and it's publicly available information, you don't have to pay for it, unless you want someone to graph it for you. But let me show you something. Here's the chart. And this goes back a ways. Well, thank you, Steve. Okay. So, let me show you something. The bottom is odd lot short sales. Okay, and it's been reversed. In other words, it's an inverse indicator. So what happens is this. Take a look at these lows, like this low right over here, and the big drop right over here. So they've taken the indicator and they've flipped it over so it looks more like what you want to look at. It's easier to visualize. Notice this. These lows, like this spike right over here, extreme increase in odd lot short sales correlated with this low. And sometimes these lows correlate almost uncanny to the day or the week or the month. So you might want to look at odd lot short sales. Remember, it's an inverse scale. It's inverted. Let me show you another one. Here's another one right over here. Okay, so here it is. Take a look at this extreme low period right over here, and take a look at this extreme right over here. Interestingly enough, and remember this is an inverse scale that's been flipped upside down, so it correlates like that. Take a look at how negative the small trader was right over here, odd lot selling short right over here, and how it was a leading indicator before this bottom. So you can look at small trader sentiment in a number of different ways. So why do we need the daily sentiment index? Odd lot short sales is only available on stocks, not individual stocks. I believe you can get it on, yes, you can get it in individual stocks, but to use it with the overall market, it's available this way. The daily sentiment index not only covers S&P futures and the Nikkei, but also all actively traded U.S. commodities and interest rate futures and currencies, so it's different. And so odd lot short sales is a very powerful indicator, and thanks for that link, Steve. Let's go forward. Moment, please. So what are we going to do about this dilemma? Which dilemma is that? The dilemma where the sentiment can remain over 75 for a long time or under 25 for a long time. We're going to continue with this process that I showed you before. Oh, by the way, this is a recent chart. Okay? So these are the odd lot short sales down at the bottom, and this is the most recent low in the market right over here. You might want to take a look at that when you have the time. I believe that the daily sentiment index is more responsive because the odd lot short sales, I don't believe they come out every day. The daily sentiment comes out every day. Let's take a look at a couple of more things that I think will... We've already talked about this. We don't want to talk to brokers. We don't want to talk to small. We don't want to talk to big traders and so forth. So I talked to you about the construction of the daily sentiment. Most important, it comes out in a report that looks like this. It gives the number for each market, for each day. And this is the one that just came out a couple of days ago, showing the percentages, up percentages, the percentage of bullish response. So for example, if we go to gold, the reading was on the 10th was 78% bullish. What would that lead me to believe? Well, the number is high, but it's not high enough. But in any event, I would be looking for a top. If you go to the gold chart, you will see there's a bearish momentum divergence setup waiting for trigger. If that trigger is hit, in other words, if we trigger with sentiment being above 75%, the probability that we will get a profitable trade is very high. There's one very high number here that I'd like you to look at, besides the number at 86%. This number right over here, cattle, if you trade the futures, 93% bullish. It's a very high number. Go to the chart, take a look at it over the next few days and see what happens. Remember, it can stay at 93 for a long time. It can go from 93 to 78 and not get a top. It's the trigger that's important now that we've gotten to an extreme situation. So zooming in on the numbers, they look like this. Excuse me. Like that. Okay, so these are some old numbers showing extremes. And by the way, if you have a chart, go back and take a look at June the 5th, 2012. Take a look at this number on the S&P 13, RBOB gas 10%, coffee 6%, and see what happened thereafter. And as I said to you before, I'm making the data available to everyone at no charge. And I'm giving you a subscription to the sentiment for, I forget how long, I promise maybe 3 months. Do what you want with the data. If you're a current subscriber, I'll extend your subscription for free for 3 months. I just want you to see for yourself how valuable this can be to your work. Okay, let's go forward. So this is a little look at how the charts look when sentiment is coming down. And remember, I'm not interested in this particular market at this time. Right over here, I become interested in it because I'm looking for a timing trigger. Let's take a look at another one. These are some old charts, and I'm going to show you some current charts. In fact, I'm going to show you a lot of current charts, and we're going to go through those charts very specifically. Here's another one. And remember, this is the issue we're trying to solve. When the sentiment data goes below 25 for a long time and stays there, or above 75 for a long time and stays there, what are we going to do with that information? And again, and again, again. How about timing? So let's take a look at timing. This is another look at the data the way I showed it to you before. Slow the sentiment down with a moving average, and another one, and another one, and another one. But now I want to get into the real stuff. I'm going to go to a daily chart. And on my daily chart, I've got sentiment in blue. We're going to go through some hypothetical buys and sells. I'm going to show you one approach to using this. The blue line, again, is a 3-period moving average, simple moving average of the raw sentiment. If you have a subscription to Genesis, we can enable you for 3 months for the data at no charge. And you can make the same charts that I'm making right over here. On Genesis, it's called JB Sentiment. And as I mentioned before, Chris Moody, who's here in the room today, is working on getting this operational for TradeStation. The blue line is, as I said, the 3MA of the raw data. The green line is a moving average of the blue line. Let's not focus on what moving average length the green line is yet. I just want to show you the concept. When the blue line crosses below the green line, we have a sell. It would be right over here. When the blue line crosses above the green line, we have a buy, which would be right over here. There would be a sell right over here and a buy right over here, a sell right over here, a buy right over here, and the most recent signal would be a sell. Now, how do we turn this into a trading methodology? Obviously, if I went short over here on the signal and it came down in my favor and then came back up again, if I'm waiting for the next trigger to go in the other direction, I'm giving up half the profit. Selling right over here at approximately 156 to the low of the move around 151 would be a $5,000 move. I don't want to give up all that money. So your job would be to find a way to lock in some of this profit and get out of danger, so that by the time you get a buy trigger over here, you have not given back most of the money, or that you're already out of the market. I can share some ideas with you about that, but the easiest way to do this would be to go to a timing trigger that you already know, and then do a correlation between the two, which I will show you before the webinar is over. I'm going to show you some specific trades that we're in right now with this methodology that I call 363. And I'll explain to you why I call it that momentarily. Let's take a look at something else. Another market. Sell, buy, a couple of buys and sells over here, a couple of buys and sells over here, buy over here, a sell over here, and the most recent signal would be a buy. Again, the process is very simple. We're simply taking the raw sentiment, slowing it down, and then taking moving average of the sentiment that's already been slowed down. Why? In order to remove all the back and forth stuff that we get, in order to not get in too soon while the market is still trending higher and the sentiment is high. So we're taking care of that problem that I showed you before. Let's look at another one. Okay, here's the S&P. It's a buy and a sell, and by the way, we looked at this chart very early in the session today. Before I go on, are there any questions about what I'm doing over here? Okay, so let me give you a little overview. What's the best way to use this information? One good way is this. When you do your trading homework at the end of the day, let's say that you're following momentum divergence. Let's say that you're looking at 14 different futures and the S&P and the currencies or whatever. And you see that there's a bullish momentum divergence set up to buy Australian dollar, for example. You would then go to your sentiment chart, or you would have your sentiment indicator on the chart. You would ask the question, what is the sentiment on the Australian dollar right now? Is it below 25? If it was, you have the AUD chart. I don't have the AUD chart, I'm giving you just an example. The AUD chart is exactly the opposite situation right now. The sentiment is very high, so you would be looking for a sell as opposed to a buy. I'm just giving you an example there. If the sentiment is extremely low, by which I mean 25 or lower, the lower the better, and you have a bullish divergence setup or a trigger, that trade will be more likely to be profitable because of the correlation between the two. That's one way to use it. Another way, which I'm going to show you in a couple of minutes, called that I call 363. I'm going to show you the combination of several methods. The most promising one that I have right now is the 8 open close, and I'll explain the 8 open close for those of you who are not familiar with it or want to get reacquainted with it. When you see the combination, I think you'll be very impressed. Okay, so let's go on to the next one. So let me review. Small trader is not always wrong. Small trader can be right for an extended period of time. Daily sentiment is based on emotion. So what to do? Slow it down with the moving average. Use it as a timing trigger with its own moving average, and take a moving average of the moving average. We're going to look at some examples right now. So bear with me. Here's the chart. It's a 363. Let me tell you what that means. The green line is a 3-period moving average of the sentiment. I'm sorry, let me back up. We take a 3-period moving average of the raw sentiment. Very simple to do. Then we take a 6-period moving average of the 3-period moving average. I want to make sure everyone understands it. So I've got my raw data. I take a 3 MA of the raw data. I take a 6 MA of that second moving average. So I've got 2 moving averages now. Then I take another moving average, a 3-period moving average of that one. So we're talking about a 3rd or 4th order moving average. It's not complicated. It's really simple. I want to make sure that everyone understands it. If you don't, I'll be glad to repeat it. And by the way, if you really want to do this, I can send everyone a screenshot of what the setup looks like on Genesis. And I know that Chris, who's very fast, has probably already programmed it. Easy. If you have the sentiment on Genesis, called JB sentiment, it's going to show up on your chart as a number, as an indicator. You take that indicator, you go to Genesis setup menu, and you go to add indicator, to add new indicator to selected indicator. Then you pick moving average, and you do 3-period moving average of the data, the sentiment indicator. Then you go to the 3-period moving average, you set it up, add indicator to selected indicator, 6-period moving average. Then you take that again, and you go to the indicators, and you say add indicator to selected indicator. You take a 3-period moving average of the 6. That's where the 363 comes from. Then on the chart, we're only showing the last 2 numbers. These are all simple moving averages, okay? Any questions? Okay. Look, the arithmetic is really simple. If you're still not sure what I'm talking about, in other words, if you know what I'm talking about, but you don't know how to set it up, don't worry. Send me an email. I'll send you a screenshot of what it should look like. Or if you're working with Chris, he can help you set it up. It's a piece of cake. It's really simple. But I want to show you what it can do for you. Remember, you got your green line, you got your red line. I've made it a little bit bigger so you can see it better. The green line crossing above the red line is my buy trigger. Notice the follow through to the upside. This ain't no small move. Remember, what you want to do is add to this a profit target so that you don't give back all the money when it moves in the other direction. That profit target can be X% of your entry price. It can be a profit target in terms of dollars, in terms of points. It can be a moving average. It can be a trailing stop. It can be a lot of things. But the most important thing I can tell you is that in almost every case that these two lines cross, you will get a move. And these will not be small moves. These moves will be big enough for you to make money on. So once you get this move, make sure you reach a profit target point, reduce your risk effectively to zero, and wait for the next turnaround. So this would be a buy right over here. If these lines are too close for you to see, in other words, you don't know if they crossed, remember these lines are numbers. Bring up your data window, Control W on Genesis, and look at the numbers. When the numbers cross, you've got a trigger. So here we triggered a sell. This again is no small move. This is a very large move over here dollar-wise. Don't let it get away from you. Determine a profit target. If you determine a profit target, then by the time it goes in the other direction for a little buy over here, you made some money and you're out of the market. You take the buy. Maybe this one did not give you an opportunity to get your profit target, turns into a sell, and now you're short, and you're getting a big move in your favor. Lock some of that money in. You get a buy over here, you get a sell over here. Notice what happens. You get very good follow through to the downside. You get a few little trades here and there, but do the numbers. Don't take my word for it. Sit down, put these moving averages on your charts if you have the sentiment data. And by the way, if you want to get this on Genesis and we sign you up for it, we will send you a special download file where you can get the entire history every day back to 1987, the first day of the sentiment. So, based on this approach, what would your position be now? You'd have been long all the way here from 1877 approximately, with the market today up another 30 points, and you'd still be long the market. You would have taken part of the profit, so you'd have reduced your risk effectively to zero. Before I leave this chart and we look at another one, are there any questions? I want to make sure that I haven't confused anyone, because I threw a lot of numbers at you and a lot of ideas, but I want to make sure you understand. Good. Let's go on to the next one. I see Frank typing. Is PMS flexible? Is PMS flexible? Oh, is the profit maximizing strategy flexible? I'm not sure I understand. You mean can I use different profit maximizing strategies on this? I'll wait for Frank. Oh, absolutely. Here's what I'm saying. Let me put it to you this way. I believe that the approach I'm showing you is really good at pinpointing market turns. I believe that, as you will see later, if you use this in conjunction with another method that is completely objective, you will get a very clear profit maximizing strategy. If you want to use this on its own, you would have to develop your own profit maximizing strategy, possibly based on some concepts I've already shown you, possibly based on something else you're using. Might be chart points, might be support, resistance, and so forth. But what I'm saying is if you use this approach, you will need to develop that on your own. My goal here is simply to show you how to pinpoint these market turns and to stress the idea that you want to get out of danger as quickly as possible. But this has very, very good ability to pick turns. And remember, it's not based on price. It's based on the perception of price, which is super important and a very different concept than what most people are doing. Let's look at another one and see. A moment, please. Okay, here is the Treasury bonds. And again, let's look at the approach. You'd be short over here. By the time it reversed to long over here, you would have achieved a profit target. Remember, this is a move from approximately 157, 158, all the way down to 150. So this is an $8,000 move. It reverses to long over here, crosses a few times back and forth over here, gets this move over here, gets this little move over here, gets this move over here, which starts right about here, and has been short from the top all the way down to here. Let's look at another one. Crude oil. Was it able to pick the recent low in crude oil? Well, there are a number of trades over here. Again, using a profit target, you're out of danger and you make some money. This is the last sell in crude, and this is where it went long the crude right over here, and it's been long ever since, and it's still long the market. Any questions about this chart? Remember what I said before. You're dealing with research. You're dealing with a new approach. You're dealing with something that is still wide open for your own research. I want you to take it and run with it and make it better than what it is. I'm going to show you some things later on that I think are really good, and you decide what you want to do. Let's go on to another one. Dollar index. Short, long, and short again. A few little trades here and there. But the thing that's most interesting about this is you do not get too many of these little crossovers back and forth. And remember this, if you're getting the big moves like this one right over here, you're having enough money on the profit side on the big moves to balance off the small amount of money that you would lose on these little crossovers. Let's look at another one. The British pound. Are there any questions about this chart? When I look at a indicator or a method, I'm always asking the question, was it able to get the big moves? So if I ask the question here, did it get this big move here? Did it get most of this big move here? Did it get most of this big move over here? The answer is yes. Let's look at another one. Another question I'd like to ask, in addition to did it get the big moves, is what happens in a sideways market? So this is a sideways market. If you have the daily sentiment index on your Genesis, set this up and go to the numbers. It's one thing to look at a chart and say, look at all these whipsaws over here, but without looking at what really happened, it's not going to be clear to you what really happened. In other words, you have to look at it and say, okay, if we sold short over here, according to the rule, in other words, the green crossing below the red, right over here, that was at approximately $70, okay? It moved down to about 68. That would be about an $800 profit. Would it have been possible, or can you develop a methodology that would get you out of danger as soon as you reached a profit target? If you said yes, as soon as I reach a profit target of X% of the entry price, I will take some money off the table and reduce my risk effectively to zero. And these things over here, which look like losing trades, turn out to be winning trades. Make sure you do it from that perspective, because I'm not giving you a trading system here at this point in time, but it will show you something much better than this in just a little while. Let's go on to the next one. So, summary. There's a close correlation between DSI and price trend. If you're a mathematician and you're mathematically inclined, you can take all of the DSI numbers, put them on a spreadsheet, and run a correlation coefficient with prices, and you will see what the correlation is. There's a close correlation between DSI highs and lows and price highs and lows, and that is a very close correlation indeed, and you've seen it in some of the charts. Daily sentiment index can remain high for long periods of time as the market tops and low as the market bottoms. We slow the DSI to use it as a trigger, and we use the MA of DSI crossover just for signals, which is what we've been doing. But what I want to do is go into some more detail with you on some combinations of methods that I'm currently using. And by the way, if you have questions, please don't hesitate to ask questions, because we have a lot of time and we will be finishing early if there are no questions. And I don't like to finish early. I want to make sure that you get your money's worth. Okay, here's the combination that I propose to you. Daily sentiment index with the 8 open close. Why? because the 8 open close is a short-term method, and the daily sentiment is also a short-term method if you use it on the daily charts. If you use it on the weeklies, it will be an intermediate-term method. Why use it with divergence? Why use it with 8 open close? Very simple. The 8 open close is designed specifically to pinpoint highs and lows in the market, to get you in very close to a turning point. The divergence is also designed to pick bottoms and tops. There's no method that I know that's better at picking bottoms and tops than divergence is. So the absolute best combination for the divergence for the sentiment trades is with divergence. That's the good news. The bad news is that divergence trades only come along every now and then. In a particular market, there may only be 2 or 3 divergence trades a year, maybe just 1. So the moves will be few and far between. There's no problem with that if you're trading enough markets. But if you're looking for more action, more trades, use the 8OC, 8 open close. I'm going to briefly review the 8 open close and show you some examples of this combination. I'll show you. And please, if there's questions, don't hesitate to ask. Okay, let's take a look. Here I've got the New Zealand dollar. Please pay attention because it's going to get a little bit detailed. On the top of the chart, I've got 8 open close. The red line is an 8-period moving average of the open. The green line is an 8-period moving average of the close. So these are simple moving averages. The first thing I want you to see is look at the correlation between the 8 open close and the 363 sentiment indicator. Interesting. The 8 open close is a little more variable, by which I mean it makes more highs and lows. The 363 is more stable. That's fine. I'm going to show you a methodology for using these in combination. It's going to be detailed, so please pay attention. We've got plenty of time to get this right. Let's go to the 8 open close. Back to the chart again. If you're not familiar with the method, this would be good review. This would be good for you to watch. If you are familiar with the method, it would be a good review. The 8-period moving average of the close, simple 8-period moving average of the close, the green line. When it goes below the red line, I have a setup. In order to trigger a sell, I need to trade below the low of the setup day by at least 2 ticks within 3 days, within 3 bars. In this case, this was the setup, this was the trigger the very next day. These are the 2 vertical lines. Going to the bottom of the chart, it's my 363 indicator. And let me say this. If I went too fast for you, now is the time to slow me down, okay? Because we've got plenty of time. I want to make sure you understand what I'm doing here. I'm taking 2 completely unrelated things. The sentiment on the bottom is not related directly to price. The 8 open close on the top is related directly to price. So, now you can catch it earlier, correct. Please explain setup and trigger once again for the 8OC. Absolutely, Shims. When the 8 close goes below the 8 open, as it did right over here, we have a sell setup. In order to trigger a sell, I need to trade below the low of the setup day by at least 2 ticks on futures. And that has to happen within 3 bars. In this case, it happened the very next bar. So this was my setup, this is my trigger. We'll deal with the opposite situation momentarily. Going to the bottom of the chart, my green line went below my red line. So on this same day as we got the trigger, the same day we got the trigger on the 8 open close to sell, we also had a trigger to sell in 363. Perfect combination, you go short. Now you can implement the rules for the exit strategy for the 8 open close, which is on bar number 5 after the trigger, 1, 2, 3, 4, 5, you take some money off the table. You've now made some profit, you reduce your risk effectively to 0, you trail a stop, and you're still in for the rest of the move. Let's talk about this right over here. On this day right over here, the green line went above the red line, indicating a buy setup. The very next day we had a buy trigger right over here. Looking at the bottom of the chart right over here, the configuration of the 363 was also bullish. Therefore, we had complete agreement between the two. Go long. So you go long at the end of this day or on the next opening. So 1, 2, 3, 4, 5. On the fifth day, you're profitable. Therefore, you take some money off the table. You will notice that during this entire period of time, watch this right over here. I'll unconfuse you. I'll unconfuse you in a moment, Lee. During this entire period of time, even though you may have had some setups and even triggers on the 8 open close, none of them were correlated to the sell side with the 363. The 363 remained bullish all through, therefore there was no combination of the two right here. Therefore, the long position initially initiated here would remain in place. So Lee's confused about the 363. There's only two lines here because on Genesis we are not showing the raw sentiment. We're not showing the 3MA of the raw sentiment. We're only showing we're only showing the last two numbers, the 6 and the 3. Okay? Does the trigger bar have to simply trade below? Yes. All it has to do is simply trade below. It does not have to close below. It only has to penetrate by 2 ticks. Okay? And Lee, if you're still not clear, send me an email and I'll walk you through it. So when you go to your Genesis screen, you're disabling the raw, you're unchecking the raw sentiment, you're unchecking the 3MA, and all you're showing is the 6 and the 3, the remaining two moving averages. That's why there's only two lines, okay? All right. Here, let me show you another one. How about this one? Here's gold. So the first thing I want you to notice is that the 8 open close had just a few setups and triggers during this period of time, and that if you took the last setup, which was right over here, got a trigger the very next day, and from that point forward, there's not been a single trigger in the other direction. Nothing. It's been long the gold ever since. Notice that on that same day, setup, trigger, and the 363 confirmed it and gave a trigger as well. All the way. Now let's look at this guy over here. Remember, we're looking for agreement between the two. Over here, the 363 went bearish, but you did not have a sell on the 8 open close. Therefore, because there was no agreement between the two, there was no new trade. If you use the profit maximizing strategy, and I want to stress, the big money is made in the big move, you would still be long this market, even in spite of today's $20 down move or whatever it was. This chart was made before the end of the day, so we don't know how it's going to look by the end of the day, but what I'm basically saying is look at the combination. Let's go back to this one right over here. Setup, trigger, and confirm. Okay? If you use the 8 open close method, by the time you had your 5th bar, it was not profitable, so you'd be out of this trade waiting for the next signal. Let me show you another one. And remember what I said. Don't take my word for it. Spend some time with this. If this interests you at all, I'll provide you with everything that you need. You will get the daily sentiment history. I'll show you the configuration. I'm showing you the rules that I'm using right now. Live with it, see what it does for you, do some back work, look at some old charts and see what it does for you. And remember, if you're not currently using the playback feature on Genesis, the replay, that will go a long way to helping you understand this and seeing if it works for you. So let's look at crude oil, and let's go to the recent signal in crude oil. Green goes above red right over here. Triggers the next day, right over here. 1, 2, 3, 4, and 5. The 5th day, it's not profitable. Therefore, this is one trade that it would have missed, even though it would have been confirmed by the 363. Let's take this one right over here. Set up to sell, trigger right over here. 1, 2, 3, 4, 5. It's still profitable on the 5th day and was confirmed. Remember, there's a profit target as well. Let's go on to the next one. I've made these bigger so you can see them better. This is a close-up of the gold move. I want to show you the combination. Let's go to the most recent one. Here's a setup on the 8 open close. Day number 1, day number 2, triggered on day number 3. If you're not clear on that, I'll repeat it. Setup and trigger. It triggered on the 3rd day by trading above the high of the setup day by at least 2 ticks. On the 1st day, the 363 was not in a bullish configuration, but by the 3rd day, it was. So right over here, we had the combination I'm looking for. The trigger on here, confirmed by the 363. I want to make sure everyone understands that before we go to the previous one, which was a sell. Is everyone clear as to why I say this was a trigger? If you're not clear, speak up. Okay, thank you. Let's go to the previous one. Set up to sell, triggered the next day because we traded 2 ticks below the low of the day. And that same day, the 363 was negative. Bar number 1, bar number 2, bar number 3, bar number 4, bar number 5. On bar number 5, we were just barely profitable. We were able to take our risk off the table, put in some trailing stops, and over the course of the next 2 days get stopped out of the last remaining positions, and that's the end of that trade. Let's talk about this one over here. Went long over here, confirmed over here. Okay? The 363 turned negative over here, but the 8 open close did not. Buy trigger 1, 2, 3, sorry. Setup, this mouse is not working well. Setup, trigger. Bar number 1, 2, 3, 4, 5. It's profitable on day number 5. If it was a losing trade, we'd get rid of it. We take some money off the table, place a stop at break even, and over the course of the next few days, the remaining positions are stopped out at break even. We make some money, and we get a reversing signal. Let's go to another one. I'm trying to make them a little bit bigger so you can see them better, so you can see the combination of the two. All right, let's check out this one. Here's the cattle market. And by the way, this is the market that I showed you before as having a bullish sentiment of over 90% as of the end of the day yesterday. I want to show you this combination. Okay, so look. Here's your setup arm, right over here. We need a trigger within 3 days. 1 and 2. On this day we triggered. On the day that we triggered, the 363 was bullish. It's a winning, it's a buy trigger. We get into the trade. We count. 1, I'm sorry, this is the trigger. 1, 2, 3, 4, 5. It's profitable on day number 5. We take 1/3 of our profit off the table. We trail a stop on the rest of the position. And by the way, anyone who's not familiar with the 8 open close, like the shams, send me an email. I'll send you the 6 best timing triggers that describes this particular method in greater detail. So we take some money off the table. Notice what happens. Over the course of the next few days, it turns negative, stops you out. And even though the sentiment gives a sell, the 8 open close remains in buy mode. Okay? You're welcome, Shams. No problem. So what happens here? Nothing. No new position, no new trade. In other words, what I'm saying is this. Here's an instance in which the sentiment is extremely high, suggesting that we may be topping this market. It's been a big move. It's been a move from about 129 to about 139, which is a $4,000 move. I'm not smart enough to know when this market's going to top, but I am smart enough to use this combination. And right now the combination says, do not go short cattle at this time. There's no trigger. So you follow the 806 procedure exactly, except you use the 360 confirm target. Correct. Correct. Absolutely correct, Frank. And that has made a big difference in my trading. A very big difference. A very big positive difference. Let me show you another one. Let's talk about crude oil. I've added something to it. I've added the momentum divergence. What do I mean by that? New low in price, no new low in momentum 28. So this would be our A, B, C, D points. This would be our setup, our trigger point right over here. And on this day we trigger right over here. On this day right over here. Notice what happens. A couple of days later, the 363 triggers. So now everything's in sync. So we've got the 8 open close set up and trigger. We've got the momentum divergence set up and trigger. We've got the 363 set up and trigger. All of them agree. And so for subsequently that, we get a $6,000 rally in the crude oil. Let me show you another one. The setup needs the trigger of 363 within 3 days of the setup. The 363 can trigger any time after the 8 open close is triggered. It's the three. Okay, yeah, you got it. Thanks. Okay. Explain momentum trigger again. Sure, absolutely. And by the way, Shems, that's explained in the 6 best timing triggers video. We made a new low in price without a new low in momentum 28. That indicates that there's bullish divergence. We should get a trigger to buy. We go back and find the previous momentum low in the last 3 months. That would be right over here. So we have 4 points. A, B, C, and D. A is lower than D. One moment, B. While A is lower than D, while B is higher than C. That's the configuration we're looking for. We find the highest momentum during that period of time, and when we close above that momentum, which happened right over here, buy trigger on the momentum divergence. Which trigger would you use to enter the trade? If you're trading 8 open close by itself, you're using the 8 open close trigger. If you're filtering the 8 open close with the 363, you're waiting for each one of them to be in the same configuration. The 8 open close went into the bullish configuration right over here, and we were waiting for the 363, and it confirmed right over here. So you could use this as your trigger, and this was your setup right over here. Did that help, Lee? Okay. Let me show you another one. Good. And remember, look, what I'm trying to do here is different than what I usually do. What I usually do in these webinars is I show everything to you, like I spoon feed it to you, I give it to you as a cookbook. This is also a cookbook, but it's a little more complicated recipe. I want you to be absolutely clear on it. I also give this to you in the form of research and say, hey, you know what? This is not completely finished yet, but it's got great potential. It's helping me tremendously. If 8 open close triggers by the bar 3, but 363 triggers on. You skipped what DSI triggers on. No, here's the deal, Frank. If 8 open close triggers by bar 3, but the 363 does not, you're waiting. You're still in buy mode on the 8 open close, and then as soon as the 363 confirms, you take the trade. So basically, it's keeping you out of trades. Be more still. You hit the nail right on the head, Tim. As I said before, you're trading less but enjoying it more. You're trading less but making more money. You're trading less and getting in on the bigger moves, and you're not getting whipsawed around, which sometimes the 8 open close will do for you. Not too often, but sometimes it will whipsaw you around. If you're adding sentiment to it, it's an excellent filter. And again, remember, it comes from a completely different source. It's not price related directly, it's perception related, which is very different than what most people are doing. Okay, let me show you another one. So less is more rules, so true. Yes, it's absolutely true, Erica. Very, very wise of you. Let's look at a weekly. Here's the weekly crude oil, okay? What do we got? Let's go to the momentum indicator first. Well, no, actually, let's go to the 8 open close. 8 open close turns bullish over here and triggers this week. At the same time, the sentiment, which has already been bullish, is in bullish orientation. So what we have here what this constitutes is a weekly buy trigger on crude oil with the same combination. Let's go to the opposite situation right over here. Setup to sell, trigger to sell, confirmed by the sentiment indicator, and goes down a lot. Setup to buy, right over here. Triggers a buy, confirmed by the sentiment indicator. In this case, we'd be out of this trade 5 weeks later. It's a losing proposition in that particular case. And then we get a sell right over here, setup, trigger, and confirmation. Let me show you one more. Let's take a look at soybeans, and I want to run through this with you as clearly as possible, which is why I made this chart so big. Let's look at the recent combination. Let's go to the 8 open close right over here. I think you would agree that the 8 of the close, the green line, is above the 8 of the open at the end of that week. There's my setup on the 8 open close. The next day, we trigger. In fact, we triggered right on the open because we opened more than 2 ticks above the high that day. There's your trigger. At the same time, the 363 was in bullish configuration. So you have the combination I'm looking for right over here. And now the risk management and the profit maximizing is taken over by the 8 open close. Bar number 1, bar number 2, bar number 3, bar number 4, bar number 5. Today was the 5th bar. It's a profitable trade. You now reduce your risk effectively to 0 because you're out a part of your position. Remember also that with the 8 open close, we have a profit target. The profit target is the largest range bar of the previous 10. That is this one right over here. So we have not reached that profit target yet, but the fact of the matter is we're out of danger. Let's look at the opposite situation. Setup to sell, trigger to sell, confirmed by the 363. Bar number 1, 2, 3, 4, and 5. Bar number 5, you're out of part of your position at a profit. You reduce your risk effectively to 0. So by the time all of this happens, you've already protected yourself. Let's go to this one over here. Setup, 1, 2, 3, trigger. This one did not work. Setup, trigger, 1, 2, 3, 4, and 5. This one would have been stopped out as well because there's no profit there. So remember, it's not perfect, but it will get you the big moves when they happen. We have 2 more charts to look at. Then I'll take questions, and we're gonna get a half an hour off early. You're gonna get a half hour off for good behavior. But I'll be glad to stick around and answer any questions you have. Let's look at the next one. Copper. Okay, now remember this, just a little backdrop. If you've got any sense of the news, you will know that the news on copper for months and months and months has been negative. Copper is no good, commodities are no good, the metals are going lower, copper is terrible, China's not using any copper, it's going to go down more and more and more, copper stocks are going to hell in a handbasket, all of that negativity, right? Let's talk about the charts. Right over here, the 363 crosses bullish. At that time, the 8 open close is not ready to buy. The next day, 8 open close gives a buy setup. The day after, it gives a buy trigger. Once it gives that buy trigger, which is right over here, we have confirmation with the 363. Bar number 1, 2, 3, 4, and 5. Right over here. The trade is profitable. And now the rest is history. Notice that for the duration of this move, the 363 has remained in bullish configuration. The 8 open closes remain in bullish configuration. And these are daily bars. This is no small move. This is the combination you want to be looking for. There's one more chart I have to show you, and then I'll take questions. And that is the Japanese yen. Let's look at the configuration. Let's go to the most recent signal. Set up on the 8 open close. You can't see it, but it triggered right on the open the next week. This is a weekly combination. So that's 1, 2, 3, 4, and 5. What happened? It went down. But the question is, did it achieve its profit target before that? The profit target is the largest range bar of the previous 10. You have to take that range of that bar, add it to this bar, and see if you achieve the profit target. If I'm not mistaken, you did, or you came close. My goal here is to show you some examples of how this methodology works, how you can apply it. Remember, let's look at another one. Setup, trigger, right over here. 1, 2, 3, 4, 5. It's profitable on the 5th bar. It's confirmed by the 363. So that's what I got for you today. I'm glad to take questions if you have them. I figured to leave myself 2 hours for this because I thought the concepts would be a little more difficult to understand, but either of 3 things happen. Either you're so impressed you're speechless, either you're totally befuddled and you have no questions, or either you're completely clear on everything and you have no questions. So let's see if there are any questions. We did 2 hours? Oh, we did 2 hours. What's the matter with me? See how time flies when you're having fun? Outstanding. Okay, very good. Thank you, Shams. And remember, I want to make sure everyone understands this. Yeah, because I was thinking we started at 3 o'clock. We did 2 hours. What a great deal. So do we call Genesis to get the DSI? No, Erica. Send me an email. In fact, what we will do is we will enable, all you have to do is send me an email with your Genesis ID number. If you send me your Genesis ID number, we will enable you. We'll send you instructions, and the instructions will include the name of the file that you're supposed to download from Genesis, and I can help you set this whole thing up. I'll send you an email with examples of exactly what you're supposed to do. But remember, I need your Genesis customer ID, and we'll enable you. Yeah, we did 2 hours. Oh boy, isn't that great? Any other questions? Have you ever used other meme crossovers that triggers those VSI? Oh yeah, I've tried all kinds of things. You know, I started using the Daily Sentiment in 1987, and I've been researching it on and off ever since then. Would you say this only works on futures? Well, we don't have sentiment on stocks except for the stock index. So it probably would work on stocks as well if we had daily sentiment on stocks, but we don't. We have it only on futures. Any other questions? Please explain how does one get access to the DSI, please. Shamus, do you have the Genesis Trade Navigator software? David, I think we will have that very soon. Chris is working on it. If Chris is watching, no. If you were to go to tradenavigator.com, you can get a free subscription to their software. Once you have that, you'll have a customer ID. You send me the customer ID, I will send you the information on how to download it onto your computer and how to set it up on your charts. Okay, Shams? If not, if you have TradeStation, Chris is working on that, and we should have that available. In fact, Chris just sent me some charts the other day on TradeStation. They look pretty darn good to me. Do you have a heart for the grains? Do I have a heart for the grains? Oh, you mean a chart for the grains? We just showed the soybeans just a little while ago, Erica. That's the only one I have. Any viability for TOS? Yeah, you know, I would have to talk to Chris about that. I do have some people that can do TOS code, but right now I don't have anything for TOS. But you know what, Jim? Send me an email and I'll look into it and see what we can do. I'd have to contact the people at TOS and see if they're amenable. If you know what, I'll tell you what, if you can import a .dat file or an Excel file into TOS, or you can have them do it for you, I can get that I can get you the data, okay? Okay. Any other questions? All right, ladies and gentlemen, it's been real fun. Boy, time passed so quickly. I was so excited to see that I wasn't going to finish a half hour early. That's great. My email address is on the PDF and the PowerPoint. Jake at trade-futures.com. Okay, it's on the front page of the PowerPoint. Okay, thanks everyone. Appreciate it. Have a great weekend and best of trading to you. Remember, this is all experimental, so try, and if you come up with something interesting and you want to share with me, I would be interested in hearing from you. Thanks a lot. Thanks, Marilyn. Thanks, Vanessa. Thanks, Lynn, for recording. I'm still on the webinar, my dear. I did. I said thank you. You're very welcome to. Bye, everyone. Cheers.